In this video, I'm going to go over the 3 buys I made in my dividend growth portfolio over the past 2 weeks. I bought 3 different companies in various sectors of the market that all pay out a dividend that is growing each and every year. These companies have diverse operations, and I believe they're going to continue to grow over a longer term period. And for each of the 3 stocks I just bought, I'm going to go over their current valuation, the current dividend perspective, and how I think the company is going to grow over the next decade. If you're new here, I am the Gen Z investor, and every single day we post about the stock market, we discuss any stock market major news, headlines, or events, and go over different stocks you can buy and sell within your own personal portfolio. And in this video, I'm going to go over the 3 stocks I bought on a dip. We've seen some crazy market volatility over the past 2 weeks. We've seen single day swings up 5%. We've seen single day declines of over 5% as well. And I use those buying opportunities to jump in and lock in 3 positions, 2 new buys for this portfolio, and I added to 1 existing position as well over the past 2 weeks. And I got into all 3 of these companies when they all saw a massive dip of at least 8% from their most recent high. So I got into a lot of these companies at a discount, and I believe they're going to be great, stable additions to the portfolio for the next decade and beyond. The first stock I bought this week is a new addition to my portfolio, and that is Merck, ticker MRK. Currently trades at around $81 a share, and they have seen over 50% share price growth over the past 5 years. On the 12-month chart, slightly in the red around 5%, but this company has a market cap of around $200 billion. And on the 52-week range, trading towards the center of the price chart. They're trading with a forward PE of 13.3, and their current dividend yield sits at over 3%. This company has seen a massive decline away from their most recent high set in the month of September and actually dipped down over 13%. I got into this company around that $76 price point last week, and I've already seen a gain of over 5% in the first week of holding the company. I believe this healthcare brand is going to be here for a long period of time, and the healthcare sector needed a boost in my personal portfolio, and this is a strong blue chip company I feel comfortable holding over the next decade. And if we take a look at their Morningstar report, the estimated fair value for Merck sits at around $86 a share. So buying in at that $76 price point, I got in well below the estimated fair value, and shares are still currently being traded around an 8% discount right now. If we take a look at their most recent report in Q3, although we went through a global pandemic and it was hardship around the world, they still were able to grow sales 2% and had earnings per share growth of over 18%, which is great to see. And they're doing a nice job diversifying away. They're a $200 billion company. They need to diversify, and they're doing that through strong acquisitions in their various revenue segments, and they're doing a nice job of partnering and licensing with some household names in order to grow the business that way as well. Moving forward, there's some nice share price expectation from Merck as well. They're expected to grow over the next 12 months by around 19.7%, and the average price target moving forward sits at over $95 a share, which would be a new 52-week high for the company. If we take a look, it is rated to buy. 22 different analysts were surveyed, 6 strong buys, 11 buys, and 5 holds. And if we take a look at their latest earnings surprises, they absolutely crush expectations. Over the past 6 quarters, we've seen 5 positive surprises and 1 in line, and when they beat those 5 times, they beat by 20%, 31%, 11%, 21%, and 12%. They absolutely crush earnings expectations over the past 6 quarters. And annual revenue is expected to grow slowly this year, of course, because of the pandemic, but is expected to pick up to over 10% future growth in revenue over 2021. And as I mentioned, I am a dividend growth investor, so every single company I buy has to pay out a dividend that grows each and every year. Merck has a current dividend yield at 3%. So that sits right in the average territory, and I feel very comfortable adding it with this starting yield. They only pay out around 41% of their earnings as a dividend, which is in a very nice sweet spot as well. That leaves enough room to continue to grow the payment moving forward, but it also allows the company to reinvest back into the business and have strong retained earnings to, of course, acquire other businesses or for research and development. And they have a nice 5-year dividend growth rate average of 5%. So a nice average starting yield at 3%, that dividend grows at a rate of 5% per year. I am very happy with those numbers. If we take a look, they have a 99 dividend safety score. And that is why I accept the lower dividend growth rate. this company's dividend is extremely safe. Very unlikely that we see a dividend cut coming soon, and as I've talked about before, during the time we're going through now with a harsh economic environment across the globe, I like the stability of companies with very safe dividends. I like knowing that my money that's invested will not see a dividend cut, and those cash flow payments will continue to come in and continue to grow, and Merrick will provide just that. And last year, they grew their dividend by 11%, which is considered fast, which is a great sign. And if we take a look at their income statement, consistent revenue growth year over year, not massive revenue growth rate, but to be expected from a blue chip dividend company, it's still nice that each and every year, top line revenue has been growing. And if we take a look at the bottom line, strong fluctuations year over year, but as of late, they've really been able to bump up their bottom line and see some nice net profit margins. Moving on, the second new addition and new company I added to my dividend growth portfolio was ticker KMB, Kimberly-Clark Corporation. They are up 5% this year, and this is a consumer staple brand I really enjoy, and I just got in on a nice dip. If we take a look at the 1 month price chart, shares have declined over 14%, and I got in right around this $133 price mark. So the company over the past few days has seen some green, but when I saw a massive decline in the market, I went in and I bought this dividend paying company. They've been operational for a very long period of time, and Kimberly-Clark is a name brand company that provides essential products to consumers that I see some strong future growth with over the next 5 to 10 years. They have a market cap around $49 billion and are trading once again in the middle of the 52-week range. Forward PE of around 18 on KMB with a dividend yield of 3.1%. So this company sells consumer products that are necessities, and that's what I like to hold in my portfolio. I like companies like Procter & Gamble and KMB, companies who provide consumers with goods they need every single day, regardless of the economic situation. Regardless of a good or bad economy, regardless on high or low discretionary income, these products are still in demand. Tissues, Cottonelle, Scott's paper towels, Huggies diapers, pull-ups, all the name brands that are continued to be needed no matter what's going on in the world with the pandemic is a strong sign and a strong company to own within a portfolio. They operate within 175 countries and are very nicely globally diversified. And of course, some of their main product segments are adult care, baby and child care, which once again will always be in demand, feminine care, that never changes, doesn't matter what's going on in the world, and of course, some other family care and some professional products as well. If we take a look at their latest investor report for the previous quarter, you can see they are nicely diversified. Of course, they have 3 main sectors of their market. Personal care, of course, makes up around half of their sales, but the other 2 segments make up around the rest, and I like their global breakdown. Half of their sales come from North America, and the other half come from outside of North America, which just shows that this company can generate income from across the globe and isn't really geographically focused on one single country or continent. This half and a half across North America and across the rest of the world really is a positive for this company. And if we take a look, they have a current dividend yield at 3.1%. They only pay out around 56% of their earnings as a dividend, and they have a 4.8% average dividend growth rate. So similar to Merrick, I like that 3% starting yield, very comfortable payout ratio at 56%. I love that range. The 40 to 60% payout ratio for me is the ideal range for a dividend growth company, and a 4.8% dividend growth rate is on the lower side, but the stability and the growth potential I see moving forward with the demand for their products growing as the cleanliness standards have only increased, I think this number will be maintained and actually increase over the next 5 years. And they have a dividend growth streak of over 48 years, very close to becoming a dividend king. One is a solid brand. They've proven to survive good and bad times in the market, and I believe they will continue to operate great moving forward. And their dividend safety score comes in at 88. Very safe. Another company where I can sleep good at night knowing my dividend payments are going to continue to come in and they're going to continue to grow. And if we take a look at their income statement, revenue has been slightly flat over the past few years, but the company has diversified themselves very nicely, kind of ensure that they will always hit this around $18 billion revenue mark, and they're diversifying themselves into new products and segments of the market to once again pick up revenue. But over the past year, you have seen a slight increase in revenue, and I believe they will be able to pick it up and cross new revenue highs. So this is the second company I added to my portfolio. I like to add a consumer staple brand during this tough time. This company serves necessities to consumers, and that is a core belief for me. I like brands that generate revenue no matter what, and this company has proven that with their 48-year dividend growth streak. The third stock I'm buying right now is Microsoft. And this is a company I plan to continue buying for a long period of time, and this is a brand that I think is a buy regardless of where the price is at. If the price is at their all-time high, or if they're on a dip, I still think this company is a buy for the extremely long term, and I think they will continue to outperform the overall market. Currently trading at $216 a share, up 46% this year, with a $1.63 trillion market cap and a current dividend yield at 1%. So I already own Microsoft in my portfolio, is the second largest holding only behind Apple, and I added more to this position when we saw the stock price dip. We saw shares dip over 8%, and I actually got in on the great day. I bought in on November 2nd at around that $203 price point. So I've already seen some green on the share price, up over 7% right now, but the short term doesn't mean too much with me with Microsoft because I'm going to be holding essentially forever. If the company continues to innovate like they've been doing right now, I think they will continue to grow no matter what. Their revenue grew 13% over the latest quarter, even through a global pandemic. When we saw all-time high unemployment, people didn't have as much discretionary income, they still were able to massively grow revenue. The company beat on both revenue and earnings per share estimates by a significant amount, and in a 3-month span, they brought in over $38 billion of revenue. And the companies, all their different products and services, all saw some massive growth. Only one single segment went down over the entire quarter. They saw their cloud platform grow by 47%. Cloud is essentially the future of one of the essential all technology companies, and that is a big growth product for Microsoft. Beautiful 47% quarterly and year-over-year growth. And their Xbox content went up 65%. And what's incredible, that is that the new Xbox wasn't even released at that point. So this next quarter, I believe, is going to see some massive growth for Xbox. Overall, the company's nicely diversified. They have so many different products. They're switching into from not only hardware, primarily focusing into software and some subscription-based models, which I think are really going to help them grow over the longer term span. So of course, their dividend is lower right now. This is primarily a growth company, and I understand that. Only yielding 1%, payout ratio of only 33% of their earnings, and a massively high, over 10% average dividend growth rate for Microsoft. They currently have a 99 dividend safety score, another company where not worried about a dividend cut coming whatsoever. They also have some of the best financial statements ever. This company, I believe, has some of the top financial statements on the market. I don't think there's many companies that actually have a better balance sheet and income statement than Microsoft. Year-over-year total revenue growth is spectacular, beautiful, consistent upward trend. They bring in a ton of net income, over $47 billion of net income, and that number once again has continued to grow very nicely each and every year. And if we take a look at their balance sheet, they have $137 billion of cash. So much cash, they can do almost anything, acquire major parts of almost any business across the globe, so much money for research and development, and they can sustain their operations almost indefinitely. Overall, they have total current liabilities on the company of only $70 billion, and overall their liabilities sit at $177 billion. Meanwhile, their total assets sits at over $300 billion. So a beautiful current ratio, strong overall ratio, and a brand that I see growing over the next decade with ease. So those were the 3 companies I'm buying for my dividend growth portfolio. I talked about the 2 new additions to the portfolio overall, and I discussed Microsoft, which I bought more of my existing position. So please hit that like button and subscribe for the daily videos. See you in tomorrow's video.